So let's look at the forward prices and arbitrage, like what we have said over here. This is what we're going to look at now. Forward prices and arbitrage. Now, if this is, just for example, this is Kenya, this is Uganda. Suppose a bond, just let me use the example of a bond. Yes, I know we are dealing with commodities, but for purposes of simplicity, let me use a bond. Suppose a bond has been floated here in Kenya and it is priced at, say, 1,000. That. The same bond, if you convert Kenya shillings, this is shillings. Suppose the same bond has been floated in Uganda at the same price, but now converted into Kenya shillings, it's probably maybe at 950. If you convert it into Kenya shillings, it's the equivalent of that. It is the same bond, but has been floated in different countries at the same time. What happens is that the analysts or the investors in Kenya, if they realize that there's an opportunity that exists in the financial market or with the bond, what they can do is that they can be able to invest in the bond, the cheaper security. Yes, it is the same security, but the cheaper security, which costs 950. So that now they can now sell it at now 1,000 when the prices are actually increased. Remember, if there are too few goods that exist like that, as compared to the population over here where there are so many individuals who want to demand, say for example, the very few, the little tomatoes that have actually been grown in an economy, what happens is that since there is so much demand for these products over here like that, what happens is that if it was initially one tomato was going for 20 shillings, now because of that demand, it will increase the prices to probably maybe 40 shillings like that. That is the same principle over here. Capital flows will go into Uganda to purchase or to procure to purchase that bond, and that will cause the prices to start moving up like that. Once it moves up like that, it will be able to settle off at the initial 1,000 shillings price over there, because we are saying we expect an equilibrium price to actually exist there. So that is what we are saying is arbitrage. So those individuals who bought the bond at 950, they will probably now decide to sell it at 1,000 shillings, earning a riskless profit of how much? So it's 1,000 that you're selling it at minus 950. They will make a clean 50 shillings profit like that. This is just a hypothetical example like that, but in the market, this is exactly what happens. Investors tend to earn riskless profit of this form like that. It's the same instrument, but you earn riskless profit by just taking advantage of price differentials if the instrument is floated in different countries like that. So we can say that for an underlying asset, there that does not pay any income, that the forward price is as follows. That where we have the F. Now we are building on this. Please note, guys, that this is what we're trying to build on. T like that. But now we include is equals to the spot price. It's almost similar to that, multiplied by the transcendental factor, E, like that, and then power R T. Put T capital. R T. Where We start with FT. We had already explained what FT is. Price, the forward price there. Then we have S, spot price. E, transcendental value. That represents continuous compounding. R, risk-free rate, cost of interest, and T represents the time like that. Now, the best way to demonstrate these forward prices and arbitrage is by looking at an example. So let's look at an example that will incorporate that there. The spot price of gold is currently at 700 shillings per ounce. The current continuously compounded interest rate is 4%. Compute the price of a 6-month forward contract on gold. So we are trying to determine the forward price. And the forward price, it can be gotten using this formula. Here you have the spot price, the transcendental value. There on your calculator you have that E, and then R is the required risk-free rate. And the risk-free rate in this case is continuously compounded. You've been told is 4%. And then you're told that the time factor is 6 months. And you know 6 months out of 12 months is what you're saying we will be able to use. 6 out of 12, because in a year we have got 12 months there. So putting it all together, we have solution. So solution, we say FT is given as, what is the spot rate? The spot rate I can see here given to us is 700. E, which you're saying is a transcendental value, the continuously compounded value. Then R, the rate we're saying is 0.04, and then times 6/12. Why 6/12? Is because we're trying to get the proportion 6 out of 12 months there. So now putting it all together, how much do we get? We first of all work out the transcendental value there. So we're saying shift E1. We want to first of all get what the value, the transcendental value is. This transcendental value I can see is 2.71828. Please check from your calculator there where you will see an exponential or the transcendental value there. I get 2.71828, and then that you now raise it to power that there. So power, it's 0.04 multiplied by 0.5. This 6/12 is the same as 0.5. Like that, I get 1.020. So it's 700 multiplied by 1.020, like that. So that you multiply by 700, we have 714.14. 714.14, like that. That is the futures price, or the forward price rather. This being the spot price, we expect that the forward price will be 714.14. How many months ahead? 6 months ahead. So 6 months ahead, we expect the price to move from 700 to 714.14, like that. So that is an example of how we can be able to calculate the forward price for an asset that pays no component of income, like that. That is it. Over here, we are done with the forward prices and arbitrage, like that.